for the interest of time, save the introductions to the time when I first bring someone in. But I think rather than the order that we decided we were going to talk on, I think we should follow on immediately from what Boji was saying and talk about bringing the developing world, let's expand it beyond Asia, and the developed world together and how they can learn from each other and the importance of doing that. And maybe I could start with Victor. So Victor Wang is the EMEA Head of Asia Coverage and Connectivity at HSBC Private Banking. So follow on from what Boji was saying. This is obviously something that HSBC thinks about a lot.
Thank you, and so pleased to be here and together with all the fellow panelists, and also so humbled to represent HSBC, especially when the earlier panelists and keynote speakers already endorsed HSBC in various ways. And actually, Assistant Dean, you also made a quote which resonated with HSBC very well, because for many years, HSBC was very well known as the world's local bank, right, with a global presence and the local expertise. I think talking about HSBC, we're rooted in Asia, right? That was 1865, and then we do a lot of business with Asia, and our mission is to become Asia's leading financial institution wealth manager, serving the international Asian and HSBC connected customers. And talking about our specific edge, right? And I think Boji earlier on specifically mentioned that if you want to do business with Asia, go there and open business out there and then bring business in. I think specifically talking about us, we see actually a lot of customer coming to us, right? So talking about the endorsement, etc. Actually, the name does work, and I believe all of us love working customers. But the reality is that doesn't often very much. It doesn't happen very, very often. So what we do, right? Many of us actually reach out, and many of us actually fly out to Asia and trying to bring business in. But unfortunately, that doesn't happen very often either, especially with the pandemic. Right. So what works well for us, especially on the Asian business part, and especially when we're talking about coverage and connectivity, is when we introduced what we call the global relationship manager model into the private banking business. It's not something new, right? It's not a new concept at all, especially in the wholesale business. But when we're talking about private banking, actually not many firms using that global coverage model, which we do. The global relationship manager often are the ones that the clients in Asia, they already trust on their own wealth management metrics, etc., and can help them actually bridge all their needs to every other places in the world. And that is what we want our global relationship managers in Asia to do, and that is what they're measured against. But actually having the access is probably just the first step, right? Bring them into this part of the market. But then all of us, actually, we're having so many experts today gathering together, spending a whole day talking about wealth management, which unfortunately is only just a small fraction of the entire industry, which if we look at it from the client lens, is probably a very, very complicated maze, right? And what they need us to do, and which is what we are doing, is actually giving them a very good guide, right, to help them navigate through this maze. And that guide has to know the maze very well, has to speak their language, which we do, and has to know their culture very well. And some of you may think, come on, Victor, don't tell us that having an Asian individual covering Asian business is a secret recipe, which is totally not, right? But there's significant difference of having just the Asian individual in the European team vis-a-vis having an Asian team physically in Europe looking after the Asian business, which is what we do. And what do we do well? Thank you.
Thank you, Victor. It's a bit unfair of me to share this, but you mentioned the phrase, the world's local bank. I remember covering HSBC, and HSBC was looking for a new advertising slogan. They were going through a bit of a tough time in that period, and a friend of mine who was quite senior at the bank jokingly said to me that they were coming up with a new slogan of "We're all over the place" instead. Grant, let me come to you. Standard Chartered, like HSBC, a multi-regional bank, very big in Asia, obviously very big in the Middle East and Africa as well. Let's talk about these connections, though, and the importance of having those connections as an institution and then bringing people together.
Yeah, so thank you, and welcome, and delighted to be here on stage with my fellow panelists this afternoon. Indeed, a slightly different focus. So Standard Chartered, present in 59 of the most exciting emerging markets around the world, with a heavy focus, as we've discussed, on Asia, Africa, and the Middle East. connectivity is important. What do we see? And picking up very much on what Victor's saying as well, a similar trend from very much the entrepreneurs, the creators of wealth in any one of the 59 emerging markets that we're based. And the journey that creator of wealth and their family are very much on. And that journey takes them through a variety of stages in their life. It oftentimes, obviously, will create a wealth management need, as we've discussed, but it creates a whole bunch of other needs with respect to preservation, safety and security, education, real estate. And, I in the brief time I've been here this afternoon, I've heard some of these themes touched upon, but that is very much, what we're here for. So when we talk about network and connectivity, we shouldn't just be thinking about the business world, but we should be thinking more broadly about what our prospective clients from these different emerging markets are looking for, because that's ultimately what's really important to them, not specifically the narrow band around wealth management.
Thank you, Grant. Alex, coming to you, Bradesco, a huge bank in a huge country with a lot of growing wealth. How are you using Bradesco's relationships with the clients locally and thinking about how you connect them more globally at the moment?
Thank you, Clive. Good afternoon, everyone. Well, it's a relatively large bank depending on which country you compare to. Right? We have around 65 million customers down in Brazil across the entire financial group. So what I always say is we are a small entity in Europe. We have a bank here, about 60 people, but I have a machine down in Brazil, right? And my competitive advantage is to connect myself with the machine, but connect myself with the clients that the machine serves in Brazil. So it's not just about wealth management or a product or a service, right? It's actually thinking about private banking and the private banker being the ambassador of the client within the group, right? We want to serve the client across the broad range, right? So it's the company that is a client of the bank, which also buys health insurance for their people, which we serve the family, and then we serve on private banking, and then we serve on international private banking. So it should be a seamless experience, right? It should be a single touch point, a single touch and feel to the whole thing, right? And I think that's the advantage that we can bring to the table, right? Different from an international bank, we are not just a Brazil desk or a Brazilian person, it's a Brazilian institution that is trying to think about wealth management on the perspective of a Brazilian client. And I think that's really what we are all about.
But unlike, say, an HSBC or a Standard Chartered, you are quite locally regional. That your main focus is Brazil. So if you have a rich Brazilian client who wants to, say, invest in China, how do you go about helping them to do that?
I think what we're trying to do first is we're serving people down in Brazil, but we actually, from Luxembourg, we're serving clients in 26 different countries, right? So we've gone beyond that border. It's a fact that some of these people will be Brazilians that have moved outside of Brazil, right? And that's also has been an important trend. So we continue to follow them up. And at the end of the day, what we're trying to build is more of an allocation portfolio, trying to see the client diversifying away from the existing Brazil risks, right? If you are an entrepreneur, either first generation or second generation, the bulk of your wealth and your generation of wealth is coming from Brazil, right? You have property, you have a lot of local bias already on a portfolio. So what you're trying to do is build a portfolio that will diversify you away from that, right? So we will not go down to the level of detail of choosing a particular stock in a particular country, but we do work a lot on the asset allocation front and try to have the client on a portfolio that will behave according to the client's needs, right, on the correct risk-return ratio over time, but against a Brazilian background. And I think that's the difference.
Thank you, Alex. Manish, turning to you, there's obviously, developing markets have been a growth story. We talked about interconnectivity, but we've also talked about deglobalization today. We've talked about some of the macroeconomic strains. It seems natural that the developed market clients would want to go overseas, that they want to broaden their investments. But is there a risk that in this environment, that's not the right time?
I would say no, because you don't manage investment on a weekly or monthly basis, and you manage investment for medium to long term. If you see the weight of emerging market in all country world index, which is the broadest equity market index, it's 12%. But the GDP weight of emerging market globally is around 45%. So there's a complete disconnect. And which is why I always say that you can't just use the established benchmark alone to create your portfolio. I mean, one thing I'll remember from my university days, my professor told me that when you may not be taking the risk, you could be taking the biggest risk in your life. So seeking safety is very easy option that everyone goes with. But you have to think about, especially in the context we are talking about multi-generational family wealth. Everything is going very well. Who knows what happens, going forward? Dollar is great, everything is great, who knows what happens? I think so. Diversification, not for the sake of just because you should have 20 different items in your portfolio. If you don't know what you have in your portfolio, that's a lot of risk. Diversification, just having even 10 items, you can get the diversity. But are you getting the weightings correct? In the Western world, everyone has, well, I'm presuming 2 houses, 2 cars, anything that you want. But that is not the case in emerging market. But then that does not mean you just go overweight emerging market big time and you're going to make your money, because the risk, as people point out, comes from lack of institutions. So great growth, but lack of institution, which means that you'll have big cycles. You will have China index going up 200% in 5 years and then giving up all the return in a matter of 6 months. So you run that risk. So you have to have exposure, but I would not say just go hammer and tongs and just buy anything. Go with an active manager who understands. Go with a sustainable manager who's taking the risk of taking small caps out or bad management out, but use that as a basis, because ultimately you're going to make money based on GDP growth, not just based on financial manipulation or any other way of making money.
And just thinking more generally about investing in emerging markets, often when you have a period of market difficulty and economic difficulty, it is the emerging markets that end up being worst hit. Do you see that this time around as we seem to be looking towards, as we heard earlier, a period of stagflation and lower economic activity?
So stagflation is an interesting thing, and as a portfolio manager on the panel, I should add my view to that. I would say that I am not a believer in inflation, and it's a very controversial thing to say given 8.3% CPI in the US. But the history of US inflation is very clear. If you go and look at the US CPI prices from 1775, from the time America got independence to now, there have been vast periods of deflation. The prices in 1913 was only 20% higher than prices in 1775. The price in 1913 was 40% lower than prices in 1813, 100 years ago. The beauty of what has happened or what happens is technology, basically. So there are 2 factors, in my opinion, which is going to bring us back into disinflation: technology and demographics. And by demographics, I mean low birth rate and people living longer. Low birth rate means low demand going forward. People living longer means more saving, which means rates are lower, and that is going to drive even more innovation. And technological innovation is not going to stop. I think the whole thing about bond yield going lower predates QE, if you think about it. And just, I mean, we see this. Everyone will remember the movie Die Hard. Hans Gruber, the villain. He was expecting 20% return on his bond portfolio, else he would not have done that robbery. If it was negative yield, he wouldn't have done that robbery, right? So what I'm saying is that, why is that coming from? It is coming from because the innovation, just low rates is all about pushing more capital in. Low rates is about breaking down supply chain, bringing in more supply much quicker. COVID has distorted that. So unless we go out of COVID effect, we cannot have a debate about the regime has changed or not. I'm a strong believer that we will go back to disinflation regime once again, but we don't know how long this lasts, because central banks cannot create supplies. That's a political thing, and things have gone wrong, but it could be 6 months, it could be 9 months, but that's where I contend that we'll go back to disinflation. And in my opinion, the base rate or the neutral rate should be 2.5%, not 4% as the market is pricing it today, but it might take 6 months, 9 months for that to play out.
Thank you. Let's talk a little bit about the nitty-gritty of managing an emerging market wealthy person's assets, their portfolio, being the advisor. Grant, How should an emerging market ultra high net worth go about professionalizing the way that they manage their money and using the advisor relationship to its best effect?
So in my experience, I think it very much comes down to the individual client and where they are and what they're spending their time doing. Many of the clients that we serve, as we've heard from previous speakers, are very much focused on their business. They're entrepreneurs, how they generated that wealth, and that can be that is their passion, and it's their principal source of engagement and where they spend their time. However, at some point in time, as they go through their wealth journey, they'll very much be looking at what else is there, how do they gain access to different markets, stability, safety, security, if they live in a market where there might be geopolitical uncertainty, range of products, skilled advisors, which is something that we've heard more about today, and therefore search for, how do they tap into that. I think ultimately the appointment of advisors comes down to how engaged do they want to be in the investment decisions, and so their degree of time and engagement they're looking for, and their personal recognized level of knowledge and experience in dealing with advisors. I think when we typically see clients, we see them with a small number of advisors. If they haven't got their own professional advisors in a family office in place, they'll typically be dealing with a small number of organizations who they turn to for different advice. They'll be on their own learning journey in terms of what they hear, what gets put in front of them, how some of these investments perform. And over time, they'll build up their own, as I say, knowledge and experience. Ultimately, putting in place professional advisors, I guess, is down to, as I say, how engaged do they want to be in the investment process, and obviously the size of wealth that they're looking at managing in an offshore context.
So do you sometimes start off more of a custodian almost, but they still effectively want to make their own investments? There's a limit to how much they'll take their hand off the wheel.
I'm thinking of a specific client situation at the moment where that's very much the case. The client's been very clear in opening a relationship with us that you should view this as a custodial relationship. I'll be making the decisions. You are welcome to put ideas in front of me, but I'll be the one making that decision. And obviously, over time, we'll hopefully build some trust with that client, and they will then perhaps listen to further recommendations which we have to put in front of them.
Thank you, Alex. In Brazil, and with Brazilian clients generally, is the advisor family office model starting to be adopted?
I think it is. It's not different from other places in the world, right? I think what's maybe a bit peculiar in Brazil is, if you think about the average mentality of the Brazilian entrepreneur or investor, or any one of our clients that has enough investable assets, is for having a base interest rate which is high, right? So the perception of risk and reward is very distorted. So right now you can put your money on Brazilian government bonds and earn 13% a year, right? And on the mind of a Brazilian person, this is risk-free, right? So the first question is, how much more am I going to make when I put my money to invest somewhere else, right? And I think there's a lot of work to be done for people to understand international markets. If you look at on the global context, the assets that are available through Brazil to investors locally is roughly 1% of the investable assets in the world. So it's a very different market, it's very peculiar, and I think that's where the advisor comes in, right? To try to help the client first understand the opportunities that we have outside of Brazil, but also make the transition. It's not just about having some money out there. There are a lot of important decisions to be made, including on how you're going to put your money out there, what sort of structure you're going to use. So it's, I think it's really the way we approach this is a holistic approach. That's why I said that the banker is really the ambassador, right? He will bring in people from wealth planning. We have a network of relationships with lawyers and other people that can help the client understand what they are doing, what are the consequences of what they're doing, what is investing outside of Brazil, that your portfolio is not going to grow every year substantially without any quote-unquote risk. And I think that's sort of what the banks are already doing, and some of the family offices are doing on the same way. But I think potentially, in the case of Brazil, there's less of a difference between the two models.
Thank you. Victor, we talked earlier on a previous panel about how the hardest conversation for a private banker to have with their client is, I'm sorry you lost some money. I guess that's even harder if they've just entrusted it to you and their hand is still on the wheel and they need to be persuaded to take it off.
Well, I think this is a perfect time probably to talk about that, especially after whatever we have seen in the market in the first couple of months this year. Excuse me. But I think what we do see, right, from the client perspective, certainly a lot of panelists early on talking about one specific word, diversification, right? Diversification in terms of portfolio, in terms of asset class, in terms of geographic, all different sorts of things. And that does help clients to weather the storm, the ups and downs of the market, especially during these turbulent time. And when we review this with a customer, I think we also see clients being more and more professional. Right, more and more professional, meaning that they're sophisticated and they understand that the performance of the portfolio goes with the market. Right, this is not some capital guaranteed structure unless this is something that they buy into. Right, and then every time when they buy into something, well, if this is execution only, fine, this is your own decision, like what what we said early on. But if this is something which is advised or something this is through the structure, then they've already fully understand the risk behind every single investment decision that they made. All we need to do, right, is just to bring them onto the table, right, and say, well, DNB is the customer. This is what we have done. This is what we discussed, and this is our view, right, of the market, and this probably is our suggestion. What do you think? And that's a very candid and very helpful conversation in most of the cases. And my personal experience at the moment, we haven't seen any clients in our own portfolio be mad about the performance so far, at least this year. Touch wood.
Let's hope it stays that way. Manish, what about your view on this concept of professionalization?
I think it depends on the size of the client or size of client. I strongly believe that if you have a substantial amount to be managed as a family, then you should have a family office, because I think you need expertise closer to you to manage it. I say this to people all the time. Just because somebody is willing to listen to you, you don't have to open up. I mean, you don't just implicitly trust someone just because they are willing to listen to you. There has to be a sense of ownership on you to judge whether this person is there and they can help you or not. And I think that is a client's fault. And when I've worked at SocGen and UBS, I've worked at big banks, now I work at a family office, which is a smaller nature. Oftentimes, I see portfolios coming from bigger banks. I won't put any names here. And you suddenly realize that, well, the portfolio was not managed very well. And you think about what happened. So basically, you trusted a relationship manager for relationship's sake to also act as your portfolio manager, which is your mistake, not the other person's mistake. Other person never told you that they were a portfolio manager. They were your relationship manager, and you went purely based on trust. So I think that ownership is on the client, not on the private banker or not on the institution. So if you have substantial wealth, I strongly believe that you should have more expertise internally, and you don't need a big office. I mean, you can combine a lot of skills internally. It also helps the family train its second generation by working next to them, right? This is where the advantage of having a good family office setup plays. It's not easy, because I think if there's one thing lacking is that to combine this two, relationship plus investment in one person, that comes with trust. But that is where the opportunity is. If you have, tomorrow you have 10 people who combine investment expertise and can also act as an intermediary to big family, you have a big business over there to develop. So long as you can separate yourself from managing and trust part, and you create an individual credibility, I think there is a consulting or whatever you call it to be there. But I strongly believe if you have big asset, you don't just hand it over to a big bank just to manage it. Just to finish it off, in this recent Russian debt crisis, I came across an example of a client, I'm not going to name the bank, 500 million being managed at some American bank, which was put in Russian bond. I mean, it makes no sense to me. You know, to just hand over 500 million of money, which, oh, it's low return bond investment, so you go and leverage it up just because the rates are, I mean, a basic understanding of risk will tell you, you don't leverage it up because 2% to make 3% extra return. These things are not going to come unless you have deep understanding of investments.
Thank you. We a lot of talk today about next gen, but I think one of the interesting things in emerging markets is first gen. And first generation, they've created the wealth. They want to continue to own the company, and they want full control of that, but they also want to diversify their source of wealth or enjoy some of the wealth they created, which is maybe tied up in the company. Victor, that's something that happens quite a lot in Asia, I think. What's the best strategy there?
Diversification, I guess. I think one of the reasons which makes the first gen in Asia successful and also accumulated so much wealth is they are all risk takers, right? They're risk takers in the best time when the overall economy grows so rapidly, specifically in that particular region, but also global economy also grow very, very quickly. When they got their bucket of gold and then they keep growing their business, certainly they know their business very well, right? And they're going to continue to do that business. They want to keep controlling their business. But we see a lot more clients making a proper allocation of the wealth outside their own business, right? Making sure that they have a proper diversification, not only the risk, but also the return, right? And they have a comfortable pot, right? And different people are going to have different definition of comfortable, right? How comfortable you are, 5 million, 50 million, or 500 million, right? And this is very much depending on the total wealth they have. And then putting that into the structure, right? Not only for themselves, right? Many of those are still very much into their own business, right? They even don't have time to really enjoy the life in a Western standard. But they're very much willing to pay for the lifestyle for their family, right? For the next generation, which Assistant Dean G mentioned a lot about, right? All those lavish stuff. They're very willing to pay those money. But also, right, we do see more and more customers paying attention to the succession, right? How they put in the wealth into the structure, how they can make sure that money goes down to the next generation, but not get wasted without any control. And also, we got more and more curious about prenup, right? It's not only their next generation, it's about the extended family, right? And this is how, I think, from the first gen perspective, worries about them and also taking more about their time and attention.
Same for you, Grant, in terms of both the first generation and actually, obviously, you know, the impact then on the next generation as well.
Yeah, very much so. I very much agree with what Victor's saying. You know, we see similar things. You know, what we really focus on in terms of the connectivity and what we would do for our clients is assisting them with some of that structuring, introducing them, as we were discussing over here, in terms of the professionals that they need to have in place in order to make sure that they are creating the structures and putting the governance, another term that we heard a great deal about, the governance in place in order to make sure that their wealth is protected. But then absolutely those broader needs that the first gen might be looking for the benefit of their family member and for the second generation. So once again, is that trophy properties in London and around Europe that they might be interested in? Is it access to educational services outside of some of the very good services available in Asia today? And you know, the other perhaps passion investments that they're interested in for themselves and their families.
Thank you, Grant. We're running out of time quickly here, so I wanted to just go to the floor to see if there are any questions for this group. Maybe you're all thinking there's a glass of champagne coming, so don't keep asking questions, Clive. But I'm going to try. But yeah, we have one just back here. Thank you.
Hello, Angel Avieiro from AG Strategy. I wanted to come back to your question before, Clive, regarding how you help a high net worth one wants to go to invest somewhere else or even in the same country. The point is, particularly for the banks, they are there. You are private bankers, but you have the corporate bankers in the banks, big divisions about. Actually, I've been heading a strategy for big institutions in the past, and I found corporate banking having 15% share of wallet of entrepreneurs, high net worth individuals, where maybe the unit of private banking had a 4%. So you dig down, and it's a question of business model, incentivization, how we get a holistic view of a high net worth individual that has a corporate perimeter and a personal perimeter, and they both interconnect. And from the viewpoint of the bank, having the unified vision changes totally the economics of that lending, return on equity, or the wealth that you can get out of the lending you have already done, right? So my question is, how has evolved and improved the business model internally in the banks in order to have that holistic view of the entrepreneur, in order to enhance what they can do as a high net worth individual and businessman at the same time.
My own experience of talking to private banks about this is that the battle to decide how to allocate revenues from wealth management clients between investment banks and the private bankers is not one that's been solved or it will be anytime soon. Alex, is this anything on your radar?
Yeah, I think it really drills down a bit on what is the mentality of the institution and the incentives you put in place to people, right? In our case, we have a lot of cross targets between different areas of the bank, including cross-selling. So if I have a client that is a business owner, at some point in time when I have enough a relationship with this person, we will discuss what he's doing on his business side. And potentially I will introduce someone from my corporate side or from my insurance side or whatever other lines of business that we can help the client as well. And the same will happen on the other direction, where we have a good relationship on the corporate side. And at some point in time, there's going to be a liquidity event and we try to bring private banking alongside. So my view is once you establish that trust relationship with the client, then you have the credibility to put other things on the table. Right? It's not really pushing stuff. It's not really forcing a situation. But if you have the right incentives in place, I think it works well. And it's the same that we have done between our team based here in Europe and the team based in Brazil. I have 130 private bankers working locally with clients. And once we have credibility over there, selling or offering this extension to the international front seems quite natural to the client.
Thanks.
And if I may, because I think I'm probably quite good, well positioned to answer this question, because actually I spent half of my career or more than half of my career on the other side of the business, in the wholesale business, in corporate investments, right? And throughout my whole career, I did nothing but inbound and outbound, right? I talked about global relationship manager, local relationship manager, etc. early on, but I think the more important thing, which actually make HSBC today, is universal and global. And when we really need to be or want to be universal and global, we're talking about collaboration, and we do collaboration rather than competing. And part of the reason that I think I'm now also in the wealth world, right, and working very well together with our other colleagues in the corporate side, in the wholesale side, is because we share the same client. Right? We share the same objective. We execute the same strategy, and ultimately, we can then celebrate the same success. It works both ways, right? As Alex, you said, right? We do leverage a lot, right? Especially as a universal bank, and this is our advantage in taking a lot of referrals from our commercial side. And they're very happy in giving those referrals because they know we can serve their clients. And at the same time, actually, we need to add an extra dimension. I talked about a complex maze early on, but actually, we need to add an extra dimension on top of that, because many of the high net worth, ultra high net worth clients coming from the emerging economies into the developed markets, they're not only coming for their personal wealth management purposes, right? They also come with their operating business, and we can bridge them, right, with a wider franchise of the institution and help them in achieving their dreams. And they appreciate that.
I think 3 different CEOs of Credit Suisse told me that they transformed the firm by synergies between the investment bank and the private bank. And twice I asked the question, so what's different this time? John, a question from you.
We started this morning hearing from Norman Lamont about potentially a bifurcation of the global system between an American zone and a Chinese zone, and there are as many reasons why that won't happen, including money moving around at the moment, as reasons that it will. How would you navigate that for your clients? And thinking of Standard & Chartered, whose towers stand side by side in downtown Hong Kong, how are you going to manage that for yourselves?
So, as I think our CEO and various executive members have said, in fact, I'm going to misquote him. I was reading an article from Ben Hung today. You know, ours is not the path of determining what will happen. Ours is very much the path of determining how we will serve our clients, depending on what does happen. So I've misquoted him horribly. But I think I don't see a total bifurcation of systems occurring. I wish I'd been here to hear Lord Lamont's discussion. But I do think that our clients, will continue, the vast majority of our clients will continue to hail from the emerging markets, and a great proportion of them from China and Hong Kong. They are on a journey, and that's a journey that will take them from the market that they've developed in with their entrepreneurial businesses, and it will take them through China. It will take them to an IPO event in Hong Kong, putting some of their wealth offshore into Singapore, and then looking at moves towards Europe and the Americas ultimately. And we'll be there to help them to do that. And that's not something that I see changing in the short term.
That's right. Got time for one more question from the floor if anyone has one. No hands going up, just a bit of waving of hair. I'll just the final question. I'm going to come to Manish. I'm just going to ask. We've talked a lot about the outbound from emerging markets, but what's the inbound argument at the moment? We're talking about finding it hard to make returns. So what should a developed market investor sitting here today should think about whether they should be investing now in emerging market assets?
So I would say that, if you're looking at some large cap companies, you're fine doing investments from here. But I think when you go into emerging market, you have to go mostly through private funds. It's my experience, because the private equity guys over there on the ground teaming up with local entrepreneurs becomes far bigger an issue to deal with. So if you're looking at some marquee names, big names, you can access them from here. But when I talk to my friends in India, and I went to IIT in India, Indian Institute of Technology, and a lot of them are now setting up businesses, and there are a huge amount of things going on in Mumbai. All the private equity guys are in Mumbai because they can't get into China, so all the money is going into India. But again, these are like 5-year, 10-year investments. So you are not going to get to a liquid stage and put it as part of your liquid investments. And nobody is better placed than to be these guys who are on the ground talking to entrepreneurs and making investments. So if you're making investment deep into emerging market and have higher allocation, I would recommend that you have to go private. I mean, all my portfolios are liquid. I'm a capital markets guy. I do liquid, but so you wouldn't see me recommending private investments everywhere. But I think when you go to emerging market, there is a merit in going through a private manager who is on the ground and has all the expertise and network to do that. So that's where you go for, because ultimately you've seen the GDP growth that's happening everywhere. I mean, in US, if you look at the US tax receipt, it doesn't even cover the 3 main spending that they have on defense, on social security, and on interest payment. I mean, it doesn't cover that. It is being driven by debt that they have been borrowing. So the real growth is going to come in emerging market, but then it comes with this risk of currency, political risk, stability, that has to be. And you can survive that much better in private businesses which have a longer term horizon and have your allocation and stay there for a longer time rather than do a portfolio in and out. In that, you're going to lose money.
Okay. Thank you, Manish. Thank you to all of the panelists.